Welcome. In this video, Hbar coin may come 280% bullish wave, so why? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand.
First of all, the formation of an ascending curve is one of the most important indicators that the price is moving in line with a specific trend line. This curve usually shows that the price is making higher lows over time, and each contact point actually reinforces the confidence of market participants. Because when investors see these levels repeatedly, they understand that there is strong support below this line. Every touch on the ascending curve is proof that the price has entered a process of gathering strength both technically and psychologically. For this reason, the price approaching this curve again is a very natural development for it to gain new upward momentum by taking support from the trend line. From the perspective of investor psychology, people often believe that a support level that has worked before will work again. Therefore, the price touching this curve acts as a catalyst that reactivates buyers in the market. It is very critical that every touch on the ascending curve also shows the strength of the buyers, because when sellers push the price downward, buyers step in at this trend line every time and move the price upward. When this repeats over and over, a very strong perception forms in the market. As long as this curve is not broken, the uptrend will continue. This perception attracts not only small investors, but also large funds and professional traders. Thus, the ascending curve becomes not just a technical line, but also a wall of confidence, a psychological barrier. Each new touch is like preparation for a bigger leap. Because as the price bounces up from this curve, both the strength of the trend increases and the confidence of buyers rises. This makes it easier for higher targets to be mentioned. Sometimes, the price approaching an ascending curve creates short-term fear in the market because everyone wonders, will it break this time? But even this fear itself actually strengthens the rise, because investors who see that the trend is working immediately step in, make new purchases, and the price makes an upward breakout. So every touch is actually a kind of test. When the price passes this test, market participants stand even more strongly behind the trend. For this reason, the price touching the curve again is not negative, but on the contrary, a positive sign, because this touch prepares the ground for a new upward wave to begin. Especially in technical analysis, it is known that every healthy pullback to an ascending trend line serves for the price to move upward more strongly. Ascending curves actually represent the rhythm of the market. Each time the price follows this rhythm, the market gains a more orderly appearance. This regularity increases investor confidence because uncertainty disappears. The reduction of uncertainty also brings more investors into the market. Especially in long-lasting uptrends, it is possible to see bigger jumps after each touch because the trend line works almost like a springboard. The more the price touches this springboard, the greater the potential of the upward move. This can be thought of as a spring being compressed. The more it is compressed, the higher it jumps when released. Ascending curves create this spring effect on the market. Each time the price bounces up from the curve, the strength of buyers is confirmed and the helplessness of sellers is revealed. In addition, the continued functioning of the ascending curve provides great assurance for the future of the price, because seeing that the trend is not broken helps investors maintain their long-term targets. Most investors know that as long as an ascending curve is not broken, the bull scenario in the market remains valid. Therefore, the price touching the curve once again is like retesting this scenario. Every test that is successfully passed brings new participants into the market and accelerates the upward momentum. This creates a chain reaction. With the entry of new investors, buying increases. As buying increases, the price rises faster. So what may seem like a simple line can actually open the doors to a massive rise. The price touching this line once again and turning upward will be the clearest indication in the eyes of all investors that the bull market is continuing. At this point, not only individual investors, but also institutional players step in, and the power of the trend multiplies. Thus, every touch actually becomes the beginning of a new story. In conclusion, every touch of the ascending curve is like a rebirth in the market. The The price coming to this level again and bouncing up from it confirms the health of the trend and gives investors great confidence. With this confidence, the rise is likely to continue for a longer period. Because markets are built on trust. As trust increases, larger capitals step in, and the rise becomes inevitable. That is why the price touching the curve one more time is not a sign of decline, but a signal of a new rise. With this touch, the price will gain momentum again and continue its upward movement strongly. But we can't make a decision based on the curve alone, so let's also look at other metrics. Keep watching.
The breaking of the falling trend structure formed in the RSI indicator is considered a highly critical turning point in technical analysis and provides very strong clues about the future of price movements. RSI, the Relative Strength Index, not only shows whether prices are in overbought or oversold zones, but also provides information about the direction of momentum. If a clear falling trend line has formed on the RSI, it usually indicates that market participants have been losing strength for a while, and even if prices give upward reactions, these moves are becoming increasingly weaker. However, once this falling trend is broken, the picture completely changes because this shows that a very important transformation in market psychology has begun. Many investors value the falling trend line on RSI as much as the price chart itself because a breakout here generates a strong signal for determining the future direction of prices. The falling trend on RSI usually parallels weak rises on the price chart and confirms that the market is under pressure. But when this trend is broken, a price movement unleashed from its chains can often be observed because investors interpret this breakout as the beginning of a new momentum. The breaking of RSI's falling trend is not just a technical level breach, but also a clear sign that buyers are starting to take control. At this point, the likelihood of upward price moves increases, since the line broken by RSI tells us that buyers have regained strength. Looking at market dynamics, the breaking of the falling trend on RSI often coincides with the beginning of strong acceleration in prices. For example, a price that has been moving with low momentum for a long time may suddenly speed up after an RSI breakout. The reason is that many investors who follow this breakout enter the market on the buy side. For them, an RSI trend breakout is seen as a kind of confirmation signal. Investors who were previously undecided or in wait-and-see mode take action with the breakout, and this drives prices higher at a faster pace. Especially when a long-standing falling RSI trend is broken, the effect on price can be much stronger because the removal of long-term pressure boosts buyer appetite. Another element to consider in RSI breakouts is the price reaction afterward. Most of the time after RSI breaks its falling trend, sharp price increases are observed in the first stage. The reason is that traders using technical analysis evaluate this breakout as a buy signal. Especially an instrument that has been under long-term pressure may gain significant value in a short time after an RSI breakout. This can be described in technical analysis as a momentum explosion. Because the breakout in RSI signals to investors that the price can now move more strongly. In addition, an RSI breakout often occurs simultaneously with important resistances being broken on the price chart. In other words, when the falling trend line on RSI is broken, price often begins to break through its own pressure points as well. The occurrence of both breakouts at the same time increases market confidence in the uptrend. When investors receive positive signals from both RSI and the price chart, this combination produces a stronger wave of upward movement, because the market sees the convergence of signals from different technical tools in the same direction as a very powerful confirmation. Another point to pay attention to is the level at which RSI moves after the breakout. Generally, when RSI rises above the 50 level after the breakout, it shows that momentum has shifted into positive territory. This contributes further to price acceleration. Breakouts that occur below the 50 level may be somewhat weaker, but still signal the beginning of an upward move. In other words, an RSI breakout should not be evaluated alone but also by considering the zone in which it occurs. Moreover, the breaking of the falling trend in RSI may signal not only a short-term price surge, but sometimes also the beginning of a longer-term uptrend. Because the breaking of a long-standing downward momentum shows that price has started to change direction and a new trend may be forming. For this reason, RSI trend breakouts provide investors not only with momentary opportunities but also with highly valuable signals for catching trend reversals. Finally, it should not be forgotten that when the falling trend in RSI is broken, the psychological atmosphere in the market also changes. Investors who were cautious before become bolder, while those holding short positions become uneasy and start closing them. This further accelerates the upward movement of price. In other words, an RSI breakout is not only a technical development, but also an event that changes the psychological balance of the market. This psychological transformation makes it easier for prices to launch strong upward attacks and contributes to the continuation of the trend for longer. In short, the breaking of the falling trend in the RSI indicator is an extremely positive and promising development for prices. This breakout shows both that momentum has regained strength and that buyers have started to dominate the market. It is quite natural for price surges to begin after an RSI breakout, because investors view this breakout as the beginning of a new rally. Therefore, in such a scenario,
the Elliott wave theory is one of the most powerful technical analysis methods used to explain price movements in financial markets and to predict future directions. According to this theory, price movements are explained by an impulse structure consisting of 5 main waves, followed by a corrective structure consisting of 3 waves. In particular, the third of the impulse waves, the third wave, is often known as the strongest and longest wave. This is because it is the stage where the largest market participants, meaning smart and strong capital, take action, and where momentum and the trend emerge in the strongest way. If the price is indeed within the third wave right now, this is an extremely positive development from a technical analysis perspective. The third wave represents the phase in which investors have the greatest opportunity to make profits, where buying pressure intensifies, and where rises are triggered like a chain reaction in the market. When Fibonacci levels are used together with Elliott waves, it becomes clear in which regions the price may pause or how far it may rise as a target. Fibonacci ratios create very strong support and resistance points, as they also overlap with the psychological thresholds of market participants. Here, the 2.272 level is particularly noteworthy. This ratio is often one of the projections that shows how much the price can expand compared to the previous wave during the third wave. If the price really rises to the 2.272 level, this not only provides technical confirmation, but also gives investors great psychological confidence. Such a deep Fibonacci extension reveals that a strong buying wave is taking place in the market and that the upward trend is continuing decisively. One of the most prominent features of the third wave is that almost all market participants move in the same direction. In the first wave, prices usually just begin to recover, and in the second wave, investors take profits and the price pulls back. But when the third wave begins after this pullback, a much broader group realizes that the direction is up. Institutional investors, large funds, individual investors, and even trend-following algorithms all join this movement. As a result, the price rises rapidly and momentum continuously increases. That is why the third wave is usually the longest and strongest wave. If Fibonacci reaches the 2.272 level, it is perfectly normal for the price to increase by around 280% during this wave. This can also be explained in terms of investor psychology. Human nature tends to act with herd mentality when seeing an upward trend. Those who hesitated in the initial rises enter the market around the middle of the third wave thinking they missed the train. This increases buying pressure. Moreover, since most technical analysts know how strong the third wave is, they'd prefer buying over selling at this point. Therefore, the third wave is the most critical stage of the market in technical, psychological, and volume terms. A 280% increase expectation is not surprising in this phase. It is in fact a strong scenario predicted by the theory. One of the important points here is that the third wave is never the shortest wave. According to the rules of Elliott theory, the third wave cannot be the shortest in the 5-wave impulse structure. Most of the time, it is the longest and steepest wave. This rule provides investors with extra confirmation of the upward movement of the price. In other words, once the third wave begins after the correction in the second wave, a much larger upward move in the price becomes almost inevitable. The fact that Fibonacci projections support this scenario, showing that the price can extend up to the 2.272 level, further reinforces the power of the third wave. When looking at the 280% increase from a broader perspective, it becomes clear how great an opportunity this is for the market. Under normal conditions, it is not easy for investors to achieve such high returns in a short time. However, in a strong third wave scenario, such sharp increases can occur. This is due to the price's momentum continuously rising and buyers entering the market in large numbers. Especially after resistances are broken, stop orders are triggered, new buy orders are activated, and the upward momentum grows exponentially. This chain reaction is inherent in the nature of the third wave. In addition, the fact that reaching the 2.272 Fibonacci level is relatively easy shows that technically there are no serious barriers left in front of the price. If the price has already broken previous resistances and increased its momentum, reaching the 2.272 level can happen with much less effort. This is a strong signal for investors because there is an upward relief in the market. This relief creates a sense of confidence for both traders using technical analysis and investors who only watch price movements. This confidence further increases buying pressure, causing the price to rise even faster. At the end of the third wave, extreme optimism is usually observed. However, the important point to focus on now is whether the market is in the middle or at the beginning of the third wave, because these stages are the periods when investors can make the most profit. The advance to the 2.272 Fibonacci level is the clearest indicator of this. If this level is reached, the market would display almost a textbook example from the perspective of technical analysis. In conclusion, the price being in the third wave and the targeting of the Fibonacci 2.272 level is an extremely positive scenario for investors. The 280% increase potential reveals how strong and reliable this scenario is. With the combination of the rules of Elliott wave theory, the mathematics of Fibonacci ratios, and market psychology, such rises become possible. Therefore, the realization of such a scenario would mean a great opportunity for investors and confirm that the upward trend can easily continue in the market.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.